Welcome to week 9. All right, so this is week 9. This is the last lecture on exchange rate determination. So let me recap a bit what we did up to last week. We started with a way to think about how exchange rates are determined using from the financial markets, right? Using bank deposits. If law of one price is to hold between countries with bank deposit rates with similar risk profiles, arbitrage should, the ability to take advantage of interest rate differentials should not last very long because arbitrageurs can come in and eliminate that ability to make something from nothing, right? And that was our starting point. Then we linked that model with the real economy, right? And after that, we thought about how to use that model to make predictions on to understand the relationship between exchange rates and output. And that's where we are today, right? So before the midterm, we were primarily focused on monetary policy and predicting how E should move in response to R. After the midterm, we linked E with output through the current account. And the assumption, however, after the midterm was that we're working with countries that adopt what's called flexible exchange rates, right? Meaning that they don't intervene in the FX market. They are completely focused on monetary policy to satisfy their internal governance demands, and they don't really have a plan to manage or maintain exchange rates at any certain level. So today is our final lecture in which we talk about different exchange rate regimes in which exchange rates are less flexible, meaning that they may be completely replaced with a different country's currency, or it could be pegged to another currency, or there may be something in between in which there's some maintenance of the currency in some way, right? In terms of guiding its path, etc. So we'll talk about those different regimes, and then we'll try to study the implications of adopting fixed exchange rates and why a country may want to use this, for example, for whatever stage they're in terms of transitioning from emerging economies to a developed one. Okay, so I'm going to start out by completing the ungraded problem set, which is just one question. You could have answered this question using just intuition of whatever you understood about the Keynesian cross and the implications of propensity to import on domestic proclivity to spend money on domestically produced goods. If you have that intuition, I think you could answer it, but I'm going to answer this more mathematically because I think it should be crystal clear why the answer it is why the answer it is what it is. So I'll do that question first, and then I'm going to give you a second way to think about the Marshall-Lerner condition, and then I'm going to show you how one would estimate the patterns of the relationship between Q and the current account using actual data. So my understanding is people may think this class is very theoretical, very abstract. Well, I'm going to give you actual data to work with. Well, I'll get some actual data to work with, and we're going to do some estimations using some statistical time series modeling. Okay. And then the rest of this stuff, as I mentioned, we're going to study fixed exchange rates, and then so I need to talk about these side topics before talking about these augmentations to accommodate for fixed exchange rates. Okay. Okay. So let me first talk about the ungraded homework 5. So let me pull that up. In a nutshell, what this question is asking you to do is to study the implications of monetary policy between a small and large country in which there are very a very specific difference. In other words, it's saying that one country has an inclination to consume foreign goods as opposed to domestic goods given a income shock, right? That's the whole difference. If you hold all other parameters constant or the same between these two countries, what's the implication on its what's the implication on the responsive output in response to a change in E, right? That's the question. Uh, but it may not appear like that once you read it. So let's read it together so we kind of understand what I'm trying to ask you to do. So imagine you have a small open economy that tends to spend a larger fraction of income on imports than large economies do. Right, suppose that's true. So that's the first statement. The second statement, import volumes are also more responsive to changes in their national income. And this question asks, does this imply that the DD's curve in the Netherlands, a small and more open economy than the US, is flatter than the DD curve in the US? So what we're trying to investigate here is the slope of the DD curve, right, for these two countries. That's the objective. I mean, that's step one. Find a way to think about the slope differences between of the DD curve between these two countries. A small country that has a stronger proclivity to import goods and versus a large country such as the United States, which has a very diverse range of industries, and they can satisfy most of their demands, consumer demands, by buying stuff locally, right? And therefore, they're less sensitive to imports. So just like you don't have to think about Netherlands, just think about Hong Kong. Hong Kong doesn't have a farming industry, it doesn't have produce industry, or very large industries. And so most of the stuff, if there is an income shock, is going to come from elsewhere, like mainly China, Australia, New Zealand, whatever. All this stuff that we eat every day, or what you see in the supermarkets, is coming from somewhere else. It's not manufactured or produced locally. So hopefully that's not too, this question is not too unrealistic, right? So in any case, let's talk about how to think about this question. And we can do that by first just extracting sentences from the prompt, from the question, and try to think about how to translate these words into mathematical expressions. So the first sentence I pulled out for you in the first bullet point on this slide, so small open economies tend to spend a larger fraction of income on imports than large economies. So one way to think about this in terms of the variables that we've been studying in the last 9 weeks is to look at the sensitivity of consumption and imports in response to changes in Y. So if small economies tend to spend more income on imports than large economies, then that means if you decide to shock these countries, the smaller countries with like 1 unit of currency or income, then you should observe a smaller response in terms of domestic consumption, right? That's kind of the way to think about this. So when I read this, this is what's thinking in my head, right? The sensitivity of domestic consumption for the Netherlands, that's the NL, in response to a unit change in Y is going to be less than the sensitivity of consumption for large economies such as the US in response to a unit change in Y, right? So I think this is a fair characterization of that sentence. So let's keep that in the back of our head. Second bullet point pulls the second sentence. And again, the objective here is to translate these sentences into mathematics so that we can, derive, understand, try to figure out what the slope difference is between these two countries, right? For the DD schedule. Import volumes are also more responsive to changes in their national income. All right, so here, before we're talking about spending money on consumption, household consumption, here we're talking about import volume. So we know so when we talk about imports, exports, we're talking about sensitivity of the current account in response to income shock, right? We know that current account is going to be negatively rated with income, right? I think we all agree, right? So, right, this is the Marshall-Lerner condition. This is the import relationship with the current account. So if we were to think about just imports quantity itself, right? This sentence tells us that the imports of the Netherlands, its response to a unit change in income should be larger than the import effects from a unit change in income, right? So another way to think about this in terms of the current account is that it's the reverse for this current account, right? The current account response to a unit change in income for the Netherlands is going to be more negative, right, for the Netherlands compared to the US. Again, because Netherlands have a propensity to import stuff, right? And also their import volumes are more responsive, again, emphasizing the dependency on imports in response to a change in national income. So I hope this also makes sense, right? The response of the current account is going to be more negative because, again, current account is equal to EX minus IM. And if you're more responsive to imports, that means it's going to be more negative, right? And therefore, the current account is going to decrease more. So the relationship between the current account and national income for the Netherlands, more negative, right? I hope that should be clear, right? So of course, both of these numbers are negative, right? Because of this relationship, but it's more negative for the Netherlands because import volumes are more responsive, according to the question. Okay. All right, so far so good. So your question would be, okay, I have these things written down, but how do I actually use these translations, these mathematical translations? All right, so this is the hard part. I'm going to rely on some calculus to derive the slope of the DD schedule, the DD curve. So in calculus/algebra, the slope is defined by the change in the y-axis over the x-axis, right? So what we're really looking for is the change in E over the change in y. This is the slope, right? The slope of DD schedule, right? In calculus, you get this, the slope is the same, but it's written in this format. Okay, the derivative of E with respect to a change in y. So how do we get this? We have to use something called total differentiation. Total differentiation is different from partial derivatives because partial derivatives, we hold certain parameters constant, right? And we're only looking at the relationship between two variables while holding everything else constant. Total differentiation means that we have to also calculate the effects of interdependencies of variables. Okay, so let me show you what I mean. By actually, doing it. So let me take the total differentiate the aggregate demand equation. Aggregate demand equation looks like this. We have consumption plus income plus government spending plus current account, which is a function of Q, which is EP star, just write Q, and the disposable income. All right, so we want to take the total derivative of both sides with respect to y. Okay. So anything that depends on y will be we will have to take that into account. So the left side is not interesting, right? The derivative of y with respect to a change in y is just 1. So I'm just gonna write equals to 1. Consumption is dependent on disposable income, so that's just that, right? So it's nothing interesting, and then dy over dy is just 1. I and G are constants in this class, so we can just ignore them. Taking the derivative of a constant is just 0. Plus the change in the current account with respect to the first parameter is Q. Q is equal to EP star to assume that E depends on Y, but P star and P do not. All right, just to make our lives easier. All right. So what that means is that if I take the total derivative, I have to take the derivative with respect to Q first, right? Times the derivative of Q with respect to on y. And then finally taking the derivative of e with respect to y, right? This is the chain rule, right? Anyways, that's how you get the total effects. You have to capture all the interdependencies of these variables in order to get the total effect, right? Can't hold anything else, can't hold any variables constant now. All right, but that's the first parameter, okay? The second parameter is just y, so derivative of the current account with respect to y, the current account with respect to y. Right? So hopefully so far so good. So let me start over. So we started with this equation. This is our aggregate demand equation. Our objective is to come up with an expression for this. You don't see it now, but hopefully you see it after I take it here. So we get something, to get this term, we take the total derivative with respect to y on the left and right side. The derivative of y with respect to itself, to a change in y, is just 1. That's the left side. On the right side, consumption is a function of y. So we take the derivative, partial derivative of c with respect to y, but then dy over dy is just 1, so I omitted it. Plus, ig is constant, so they become 0 after you take the derivative. We take the derivative of the current account with respect to q, because q depends on e, which depends on y. So then we do the chain rule, q, derivative of q with respect to e, and then the derivative of e with respect to y. And then we have the term that we desire, right? So all we have to do is rearrange this entire expression so that this is on one side and everything else on the other. And lastly, there's another parameter here, so just plus derivative of CA with respect to y. And then dy over dy, which is just 1. Okay, so this is our dynamic, right? This is our dynamic equation. But let's just move stuff around. So 1 minus, let's bring this over. So partial c over partial y. That's this term. And then let's bring this term over. Minus partial ca with respect to partial y divided by, and then this stuff here. dca over dq. And then the partial derivative of q with respect to e is just the price ratio. So this is not important, but anyways, let me just put that here, okay? And then all we're left is dE over dy, right? All right. What do you notice? You notice that our discussion of the question, we come up with 2 inequalities, this one and this one. And guess what? The relationship between C and Y and the relationship between the current account and Y is in the numerator, right? That's this term here and this term here, correct? So for the Netherlands, this value is smaller. So a smaller value would mean that this entire expression is bigger, right? So for the Netherlands, okay, this term is more positive. And secondly, this term, the current account with respect to y, is going to be negative, right, by assumption. So negative times a negative is a positive number. So this is a positive number. But we concluded that this term, the relationship between CA and y, is more negative for the Netherlands. So a lower negative, so a smaller, more negative number, meaning a more negative times a negative is just more positive. So in general, in fact, the entire numerator is more positive for the Netherlands, right? So, right, so I wrote this here. Therefore, Netherlands have a larger numerator, and if your understanding of slope is, you know, flat to 0, right, flat curve is 0, then any number that's more positive is going to be more steep. So if you want to plot this, you can. So all else equal, of course, we're going to assume that the denominator is the same for both countries, just for the sake of analysis here. If I were to plot this, I can. So all else equal, the numerator is the only difference between the Netherlands. we would have a steep slope for the Netherlands and a not so steep close slope for the US. So NL, let me write DD and L and DD US. If the Netherlands and US have the same A schedule, we can conduct a monetary expansion to see its output effect for both countries. So let's assume that they both have the same A schedule and shifts upwards. And you can see that the impact on output is going to be larger for the US, right? So this is the delta Y for US, which is bigger than the delta Y for the Netherlands. Right. I mean, you could also see that by, right, when you realize, first of all, that dE over dy for the Netherlands is greater than dE over dy for the US. If you want to know the impact of monetary policy, whether that's weaker or stronger for the Netherlands, you just take the inverse, right? That just means that the output effect in response to a change in E for the Netherlands is going to be smaller, right? So monetary policy is less effective for countries that are more dependent on imports, right? That's the conclusion here. All right, so this is the rigorous mathematical way to make your case, right? As economists slash mathematical modelers, we're all mathematical modelers by the end of this semester, okay? Based on that framework, this is your conclusion. But of course, you can think about this in a more intuitive way. Recall from the Keynesian cross that the reason why certain aggregate demand curves are flatter or steeper is because of the multiplier effect, right? The Keynesian multiplier, meaning that if a country is more dependent on domestic consumption, then the output effect is amplified, right? And right, so a flatter curve means more savings or going towards imports in this case, then the output effect is not so much. But a steeper one, you get much more output effect when because of the feedback, right? Because if you want to consume more domestic goods, then that's going to boost consumption, which boosts output, which further boosts income, which further boosts output, and so forth. So consumption and production are feeding back into each other. That's the multiplier effect. But if it doesn't, if it's dampened because certain countries like the Netherlands is more inclined to import, then that amplification effect is not so strong, right? In that case, you can kind of understand now why this is true, right? Make sense? And you can see it in the code too, right? So where does the multiplier effect show up? It's here, right? Here. So if you are more inclined to buy your own local stuff, you will produce more, everyone makes more money. With more money, people consume more, etc. So feedback. So that term, right, is shows up there. Okay, that's question 5. I believe the most difficult part is proving it, and I won't ask you to prove it in this class. So if you were to do a comparative macroeconomic model and understand like the effectiveness of monetary policy or fiscal policy between these subtle differences between countries, you can just memorize this equation, right? or just write it down somewhere. But at least you understand like what these parameters mean, right? Uh, propensity to consume when there's an income shock, propensity to import when there's an income shock. Uh, the relationship. So this is the Marshall-Lerner condition, right? This is positive, but to what extent does prices pass through to export? That's a pass-through thing. That's also can be quantified. Uh, and then the price ratios, right? So you understand basically every part of this equation here, right? Okay. All right, so we have that done. All right, I'll talk about a different version of the Marshall-Lerner condition when we get to it in the slides. But let me refresh your memory. The Marshall-Lerner condition is a condition that must be satisfied so that there's a positive relationship between real exchange rates and the current account. This this sensitivity is important because it tells you whether or not prices actually translates into import export actual import or exports because of the incentive for people to substitute away from expensive goods in favor of cheaper goods, right? If prices don't change, right? Imagine if Trump implemented a tariff and prices don't change, then there's no pass through, right? That means you cannot rely on Q to have an impact on output, right? So it's an important condition to understand. Otherwise, your policy that if you're a policy making, you're making some suggestions, it doesn't make any sense if there's no pass through between prices Q, real exchange rate, right? EP star over P. It's just a ratio of price levels between countries, and then the price of a foreign currency, right? That's what it is. There's no transmission between prices and the current account, then you don't get any output, right? So uh we understood this condition between two counteracting opposing forces, right? One is called the volume effect and the other is the value effect. So I think that's uh the most intuitive way to think about it for now. But if you want to just think about it as a pure import-export effect, you can also do that without this value effect. But it requires you to rewrite everything in terms of what's called elasticities, meaning like uh, export sensitivity to price changes, percent price changes. So percent change in something leads to a percent change in Y. So once we do that, then I think it gives you a pure volume explanation as opposed to having this value and volume effect thing, competing forces. So once we get there, you'll see how I do it, right? So let me write old way of viewing Marshall-Lerner competing effects between volume versus value effect. Today's view of Marshall-Lerner condition, relative export sensitivity between countries in terms of elasticity, i.e. percent change response to percent change in Q. Okay. Or EX, okay. All right, so we'll get there when we get there. But let me remind you what we were working with. We need to do some substitutions with this equation here, right? So this is the volume effect, this is the value effect. And we can rewrite everything just in terms of now elasticities of exports, and we don't have to think about values anymore. Okay, let's move on to today's agenda or lecture. So today we're going to be talking about fixed exchange rates and managed exchange rates. We'll be mostly discussing what's managed, but when we analyze the differences of its policy implications, we'll be focusing on fixed exchange rates because all else equal, managed in the short term is basically the same as fixed. Just means somebody's going to intervene to do something about it if the exchange rates move too much. Whereas fixed exchange rate, if you want to take it as strict as possible, just means it's not allowed to move, right? Which is good enough for us. Okay, we don't have to dive into too much details about managed over like a long term. Okay, and then we're going to compare the pros and cons with flexible exchange rates, which is what we've been studying up to last week. Okay, so that's the goal today. All right, so let me first talk about let me characterize the range first to give you an idea what the extremes are for different type of exchange rate regimes. So we have two sides basically. One side in which you fully give up the ability to have monetary policy. Okay, so meaning that you don't even need a central bank, you'll just adopt someone else's currency, right? That's one extreme. So I would say dollarization is the extreme, meaning that a country just borrows another currency and just says, this is our currency now. Okay, so Macau is kind of like that. They have you can spend Hong Kong dollars in Macau, right? And it's as if the central bank of Macau doesn't do anything. What's the point of having a Macau dollar at all? The peso, is it a peso? I think so, something like that. Anyways, uh, uh, in other South American countries, they have the same thing. Instead of they have U.S. dollars, they use U.S. dollars instead of their own local currency. So the problem with doing this, you can imagine, is they have no control over interest rates, right? They can't do any policy involving, you know, holding on to cash versus saving. You can't control the savings rate, and therefore you can't boost the economy or control inflation at all. Your entire economy is dictated by another country's currency they decide to adopt, right? So that's one extreme, right? No monetary policy whatsoever. The other extreme is something we've been studying all along, right? It's when you have you like having your own currency, you like to be able to control the supply of your own currency, and therefore you control your own interest rates. But at the same time, you don't really care about what the exchange rate is with other currencies. It's kind of a side effect. So whatever, if I decide to devalue my currency to save my own economy, I don't really care about other countries. Too bad your currency gets stronger, you think you do whatever you need to do, right? So that's the other extreme. All right, but in between, there's a lot of color, right? There's a lot of subtleties between fully dollarization versus floating. So as you can imagine, you could have like a crawling peg, right? Or first of all, right, instead of a dollarization, you could have a peg like Hong Kong, or like a traditional peg like Saudi Arabia, or Hong Kong where you have a band, right? That's what Hong Kong has. You can have the band move over time, right? That's a crawling peg or a crawling band, or you can have the peg change, over time, right? So there's lots of things you can do in between, right? So a lot of subtleties in between. So something between, a pure peg or dollarization versus a floating, right? Lots of things you can do. And so I'm supposed to help you understand those those minor differences across the board. Okay, just to give you just to give you a taste of what other countries have decided to do. Okay, so the extreme, right? Let's talk about the extreme. We have an exchange arrangement with no separate legal tender. That just means that you just take other countries' currency and use it as your own. There are several countries that do this. So let me give you a list. Ecuador is a country that uses only dollars, US dollars. Okay, they don't have their own currency. El Salvador, they used to use US dollars. I think they still do, but they also now adopted Bitcoin. Again, Bitcoin is not owned by anybody, right? So that's almost the same as dollarization. You just borrow the global currency, but there is no monetary policy for Bitcoin, so you can't control interest rates, right? So let me tell you, right? Ecuador uses US dollar, El Salvador uses USD/BTC, right? And then I believe up to recently Zimbabwe also uses the US dollar, but now I think it's a gold standard. If I recall correctly, that's what I said, but in the past they did fully dollarize their currency because of hyperinflation, obviously. All right. A currency board is what Hong Kong has and also what Brunei has. So Brunei currency board is somewhat is subtly different than a conventional peg because they reserve the right to change the band in which the currency can move around with. So it's not a pure peg. But in terms of maintenance, Hong Kong and Brunei still has to maintain a currency reserve to be able to defend the band, right, at any point in time. So let me tell you, Brunei, they don't use US dollars, they use Singapore dollars as their peg, quasi-peg. Hong Kong uses the US dollar as their band or benchmark, right? Conventional fixed peg is what we typically imagine what a fixed exchange rate is, right? This is the gold standard. This is what people had. Some fixed quantity of your currency can exchange for 1 unit of another currency. That's what a fixed peg arrangement is. So this conventional peg is adopted by Saudi Arabia, and the currency they peg to is US dollars. So hopefully should not surprise you because oil prices are quoted in dollars for that reason. Okay. Okay, pegged exchange rate with horizontal bands. So this is like a central bank changing the size of the band around a currency target, right? So imagine we have E, right? And there's some target, whatever it is. Sorry, let's just do. And then the central bank decides to manipulate the band around that target, right? So the currency can fluctuate, whatever, blah, 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 right? And so, for example, you have X% around a target, right? That's what a pegged exchange rate with horizontal band. So the country that has this is Tonga. This is not a very popular way to do it. So this is a small country and their currency is allowed to fluctuate around a band for certain exchange rates with other countries. All right, crawling peg. So we're getting closer and closer to what China has or used to have. I'm not exactly sure what China has nowadays, but in the past it's something similar. So a crawling peg is no horizontal bands yet, but the country does pre-announce what that exchange rate should be, that fixed exchange rate should be across different points in time. So for example, if you have a peg at this level, maybe they announce, in a few years that it should be higher, maybe higher over the next few years, but then they reverse course. But this is all pre-announced, right? And these are pegs, right? This is a fixed exchange rate. There's no band yet, right? So Nicaragua has such arrangement. All right, so exchange rate with crawling bands. This is China. Or what China used to have. I'm not sure what they have now. So what this is just an augmentation of this, right? So rather than fixed exchange rate, the exchange rate is allowed to float within bands, of course. So they'll pre-announce these bands, right? And maybe it's allowed to decline. So the exchange rate goes like that. So you can see it's it's managed, right? It's managed in the purest sense. Like they're literally just lining it in the direction they want to go, but of course they're allowed to have deviations, but it's fine. Right, it's moving in the general direction that they want it to move. Okay, so as we move away from this, very managed, micromanaged way of doing things, you can do things more indirectly. So countries like South Korea and Thailand, rather than manage the currency directly, these guys have inflation targets. So you can see there's many ways to mitigate, manage inflation. One is through, of course, printing and printing and contracting money supply, right? That's one way to do it. But another way to do it is to control your exchange rate with other countries. That's another way to do it. So it's a very indirect way. But the point is they go into the FX market to either buy up or inject more of their currency in the system. Okay. So it's important to know, like, this thing and this thing, there's no one specific country that currency is pegged to or managed against, right? It's a basket of currency that they're thinking about. So I don't know what the exchange rate would be. So E could be against like a basket, a weighted average of currencies, right? As opposed to one country versus another. Same with this, right? So the inflation target, they would think about which exchange rate is causing most of their inflation, and they try to mitigate that by intervening in the FX market, either buying more South Korean won or injecting more, right? All right, and lastly, on the other extreme, we have a purely market determined exchange rate. Countries like USA, UK, New Zealand, Australia, a US, Canada, whatever. Okay, you get the idea. So again, these guys don't care what the exchange rate is. They have no desire to manage it. They don't care what the path is. They're not gonna, there's no reserve of foreign currencies. Okay, they don't do that. They just let the exchange rate float against whatever it is and with other currencies. And the reason is because they want that power to control money supply at their will. Okay, if they want to create inflation, they create inflation. They want to create deflation, and they don't care what the exchange rate is with other countries. All right. So that's a taste of the global exchange rate regimes. As you can see, it's very, very diverse. It's not everyone is here, right? Not everyone is here. Most people are, if you want to look at just country distribution, right? It's probably around, everyone's probably somewhere around here, right? Something around managed, but it's quasi market based. And then you have purely market based. And then you have few countries which are more like tax havens, right? You have Hong Kong, and then you have this special case of Saudi Arabia, which is an oil exporter. So these are extremes because of their businesses that they do, right? And then you have these other countries that are basically don't understand finance, and they just borrow other people's money, right? Okay. So let's talk about the Marshall order condition in another way. So the reason why, again, reiterating myself to emphasize the importance of this condition, it's important because otherwise monetary policy, I'm sorry, policy that requires you to intervene in the FX market wouldn't make any sense if the Marshall order condition isn't true, because the Marshall order condition tells you how prices transmit to output. If that condition doesn't hold, then any of this exchange rate manipulation doesn't make any sense, right? We need to justify intervention somehow. And this condition, therefore, is necessary. Uh, in the past few weeks, we learned that it's the competing effects between what's called value effect, volume effect. Today, I'm going to give you another way to think about it. So let me tell you how to do it. Okay. So let me prove it to you first in a different way. All right. So the Marshall order condition is we're starting with this. Okay. This tells us that the sensitivity of the current account with respect to a change in real exchange rate or price levels, right? P star P and E is equal to import sensitivity, right? This is domestic import, and here is foreign exports, which is, yeah, foreign exports. And then we have the value effect minus EX star. All right, and what we can do is now think of everything in terms of elasticities. So what that is percent changes. Uh, so imagine we want to rewrite our EX. Okay, I'll use delta. Okay, imagine you want to write EX over Q, right? But instead of working with this, let's work with percent changes. So that's delta EX over EX, right? That's percent change. Divided by delta Q over Q. All right, do you see that? Percent change in EX, percent change in Q. Okay, so this is going to be labeled as eta. So this is the Greek term for eta, and that's exactly this. Okay. Any questions on this new definition? So this is a definition, okay? I haven't told you it's not a derivation or a proof, it's just a definition. Eta is the elasticity, the Q elasticity of exports. It just means that the percent change in exports in response to a 1% change in Q. Okay, that's what eta is representing. We can do the same for eta star. Percent change in EX star in response to a 1% change in Q. Okay. We can rearrange everything so that we rearrange everything so that we can replace everywhere that looks like this with something that has eta in it now, right? So let's try to keep this and this and then move everything else to the left-hand side. So you can do that by, let's just move the denominator into the numerator. So that's just flipping the fraction, right? So we have delta EX over EX times Q over DQ. Sorry, delta Q. So we have this. We want have what we want, right? We want to preserve this. And let's move EX and Q to the other side. So eta times EX divided by Q, right? So we will replace everything we see delta EX over Q, delta Q, right? Or dxd, the derivative of EX with respect to a change in Q, right? The change in EX with respect to a change in Q with this term here. That's it, right? So that's what I wrote here. We replace everywhere where we see partial derivative of EX with respect to partial Q with eta, it's supposed to be elasticity, right? Percent change now, multiplied by EX over Q. Do the same thing for 4 exports. So plugging in these terms into this equation here, hopefully you see that what we are replacing, we're replacing this, and we're replacing this. We should get something that looks like this, right? So notice that the Marshall-Lerner condition states that this sensitivity has to be greater than 0, but now we're just rewriting everything in terms of elasticity. We rearrange the terms, and so I'll leave this to you to walk through, okay? But I'm just rearranging the terms. And the final expression that should give us an idea how to think about Marshall-Lerner condition in terms of purely exports is the following here. So maybe this is still not intuitive. Well, let's think about a country that has a trade balance. Current account equals 0. That's when exports equals imports. So this just goes to 1 when you have a country that has a trade balance, right? And so the final condition for the Marshall-Lerner condition is just the difference between Q elasticities of export greater than 1. And if you recall your microeconomic studies, elasticities greater than 1 means that this propensity to export is elastic, right? Meaning that A 1% change in Q leads to a greater than 1% change, right? It's amplified, right? If it's less than 1, we say it's inelastic, right? That's if you recall your micro. Okay. Anyways, that's why it's 1. That's why this 1 is important, because anything above 1 is considered elastic, right? In other words, there's an amplification effect, right? 1% leads to more than 1%. And that's only the case if the elasticities of export in response to a change in Q is greater than the other country's elasticity by greater than 1, right? So that's another way to think about this. A purely export formula now, right? So obviously things can help, right? What this formula here above tells you is that it's much easier to get to satisfy the Marshall-Lerner condition if you are a net exporter, right? If your export is huge compared to your imports, it's much easier to get this output effect coming from price level changes or price changes, right? Q can have a bigger impact if you're a net exporter to begin with. All right. So that's the mathematical formulation in another way. Hopefully it gives you more insight into what helps you to get more pass-through. But of course, now you should think about what scenarios would there not be a pass-through in which prices don't change in respect when there's a change in Q, okay? Through E, for example. So let's go back to the slides. So here are some reasons for incomplete or no pass-through whatsoever. So just because you change E doesn't necessarily mean that price levels in general would change, and therefore there's incentive to import or export, right? That's the whole mechanism here, right? Just like the gold standard, the reason why there people are substituting away or importing stuff from somewhere else is because relative prices have changed, and therefore I'm trying to find a bargain somewhere else. But just because E changes in reality, it doesn't necessarily mean that overall price levels are going to move in the same direction. Okay. So I gave you 3 reasons, but the first reason and the third reason are basically related. Okay. So pricing to market is a term meaning that sometimes the prices are determined based on preservation of the customers in your market, right? So wholesalers and retailers may decide not to adjust prices to maintain market power or maintain profits, something like that, right? Or sorry, maintain market power or maintain a customer base. If you're purely profit driven, then yes, you would adjust prices because your cost of input rises. You have to transfer those costs to your customers in order to maintain the profits. Then you should see a price effect. But wholesalers, retailers, and also possible other sellers may decide not to transfer those costs onto the consumers and therefore they play the game for the long term, right? They maintain their customer base, they maintain their market power, and therefore you don't see this pass through in which Q impacts the current account, right? So these two will dampen the effects of Q having an impact on exports and therefore output. All right, so the chain is Q, CA, and then Y, right? All right, and the second reason, or the third reason, is distribution costs. So while it's possible that prices change, that's fine, but you may not see a change in trade volume because the cost to move the goods, right, is still so prohibitive or expensive that small changes in prices aren't enough, or large change in prices is not enough. So think about like military weapons or anything involving nuclear stuff, right? Just because there's a price change because of the exchange rate doesn't mean more military stuff is going to be sold or not sold, right? The cost to distribute this is so prohibitive that any change in price doesn't really matter, and so there's no trade volume effect whatsoever. Okay, so these are just a couple of reasons why there may not be a change, an output effect change in response to Q, right? So it could be approximately 0. All right. So with that in mind, with that discussion of pass-through, let's suppose there is pass-through. And if that's true, then countries can now think about having a current account target, right? If they believe that they can change prices, they can change E in their favor, making their exports more favorable compared to other countries, then maybe a government or central bank wants to set a target for their total exports minus imports. And we can represent that on a graph in the AADD schedule, right? So let me show you what that looks like first. So yep. So let me show you what that looks like. So we have, so I'm gonna do this fast. Okay, so we have a schedule, schedule. It's gonna look like the following, and I'll explain to you why it looks like the way it is after I draw it, okay? So it's gonna be upward sloping, I'll explain that, and it's gonna be flatter than the D schedule. And so it will look like this. So assuming we're in equilibrium, assuming the country has hit its target, then the intersection of all these three lines is the equilibrium, okay? It's the point where nobody wants to do anything else. So this is gonna be the XX schedule. Okay. So let me tell you what that looks like. Let me remind you what these other graphs represent. This is y equals d. And the XX curve is represented by CA target. I'm going to do that underscore T for target equals to the current account function of Q and y minus T. So it's important to know that this value here is a fixed constant, right? It's just a raw number, $7 billion, $100 trillion, whatever, or different euros, Chinese yuan, doesn't matter, okay? It's just some number that the central bank of government wants to hit, okay? So why is it upward sloping? All right, so if the left-hand side is constant, and this Q is equal to EP star over P. If I increase E, that's going to increase exports, but that's going to miss my target, right? So how do I undo this increase in the current account? Well, I can increase my disposable income, which increases imports, which brings it back down, right? So increase in E will lead to an increase in Y, upward sloping, right? Clear? So that's number one. Okay, number one insight. Okay. Number two, you should be asking why is it flatter? Right? That's the second question. So let me prove that to you. Why is the slope flatter? The current account target equation is the following. Q y minus t. I want to look for the slope of the XX, which means that I'm going to try to look for dE over dy again, right? This is what I want for the XX curve, right? For the XX curve. How do I do this? Total differentiation again. So if I take the left-hand side, take the derivative of it with respect to y, it's just 0 because it's a constant. And then I have partial CA with respect to, in this case, Q first. And then Q depends on E. and then E depends on Y, just like last time. Plus the other parameter, which is Y. So that's just partial CA with respect to Y. And then dy over dy is 1. Okay, so let's try to isolate this. So we move this term to the left-hand side over dy. And then we divide everything by dCA over Q. And this is just price levels, right? P star over P. This is equal to dE over dy, the slope, right? For XX. So what do you notice? It looks very similar to the DD schedule slope, right? But it's missing that multiplier term. So let me let me refresh your memory. Just a few slides ago. Right. This is the slope of the DD schedule. Everything else is the same, right? This term here, this term here. The only difference now is this term. This term is missing. This term is positive and it's missing. With a smaller numerator, the slope of the XX schedule therefore is lower, and therefore the slope is flatter. Okay. So the conclusion here is that this slope is less than dE over dy of the DD schedule. Okay, so that's why it looks like this. That's the second insight. Okay. First insight, E and Y move together on the XX schedule. Why? Because in order to hit the target, E and Y are trade-offs, so they have to move together. They move the current account in different directions, so they have to move together. Why is it flatter? It's flatter because it's missing the multiplier term, right? It's missing that positive number, and because of that, the slope must be less than the DD schedule. Third insight, how do you shift the DD schedule? How do you represent a change in the target of the XX curve, of the country? So let's go ahead and think about how to do that. So let me delete this stuff because it's in the way. Oops. All right, so if this term is increasing now, there's going to be an inequality like that. If I fix y naught, so holding this constant, how do I move q so that the current account also increase? Well, I have to move it upward, but that means that E has to move up if P and P star are constant. So that means that this point here for this y naught value, right, for this point, I have to move to a higher level of E. In fact, every point on the x-axis curve has to move up. Oh, that's a bad line. Yeah, whatever. Okay, fine. All right, so that is how you shift the x curve. So this is third insight. So now you have, based on last week, you already know the kind of things you can do to hit this new target, right? How do you hit the new target? You have to make sure the AA and DD schedules intersect on somewhere on the XX prime schedule. Correct? You have to find some way to make AA and DD hit the XX prime curve somehow. So if this is where you want to be, you can shift the AA schedule. And you know how to do that. Expansionary monetary policy, right? That's just one thing to think about. So to give you an idea what your choices are, you can do, permanent monetary policy can maybe allow you hit that line point here. Maybe you can do temporary policy, which is not so effective because it's not unexpected. You could do fiscal expansion, which will get you down here. You'll move away from that target, right? And then permanent is really bad, right? You get something that's even further away. So this is a perm fiscal. This is temp fiscal. This is temp monetary. And this is permanent monetary. Monetary. Okay, sorry. So if I were to give you a question, like they decide to cut their current account target, okay? They decrease their current account target. Tell me what happens to the x-axis curve. It moves somewhere. Explain to me what policy you can implement so that you can hit that target. Right. These are all, I think these are reasonable questions I could ask you on the final exam, right? Just to test your understanding, visual understanding of how, the countries that decide to manage their exchange rates, how they accomplish this, right? So of course, these are just reference points telling you where they are. So if they do decide to cut their excess curve, then fiscal policy may be a good thing to do. Right? Depends on what their objectives are. So let me summarize again. So this is a summary, okay? X shows all combinations of output and nominal exchange rate for which the current account attains the target level. Target level is a constant. It's arbitrary. It's set by. This is different for every country that decides to manage their exchange rate to achieve. The whole purpose of doing this is to achieve their target. Okay, it's upward sloping. Should be. I think it's easy. We done that right. We hold it constant. We realize that increasing Q will have opposite effects of increasing Y, so they have to move together to maintain that target. It slopes less than the DD schedule because of that multiplier effect, right? It's missing that thing. And so the numerator is smaller, and therefore the slope has to be flatter. And you know how to shift the curve now, okay? All right, so let me give you some empirical exercise to tinker with. So we talked about volume and value effect, and do we actually see this in the data? And the answer is yes, and I'm going to show you how it's done. All right, so I already talked about this reimagining of the Marshall-Lerner condition. It's clear that it's easier to get pass through when exports is large, right? Because that amplifies the sensitivity of your export. But in terms of trade balance, if this is one, then I think it's very intuitive, right? This difference has to be elastic in order to have a pass-through effect. All right, so in reality, when you decide to change Q, the current account will typically have this pattern. So imagine this is the zero line, okay? This is this is zero. So current account could be positive or negative. I think people, so let me maybe refresh EX minus IM, right? So it's possible to have a negative current account. This is what happens when you decide to change Q empirically. If you look across different countries, the Q will cause the current account to decline in the very, very short term. And then over time, it will increase. And it's in this area, right, that we have pass through, right? This is the volume effect. volume, volume effect, and this is the value effect. This is where ML fails. This is where ML holds. All right, actual data, right? So let me pull up actual data for you. So this file, I placed this file in the articles folder. So if you want to look at it, you can. Otherwise, you can just listen to me explain to you how to do it. Sorry. All right. So this is the final result, but let me show you how it's done. All right. Hopefully you can see this. This is quarterly data of macro variables for the EU. Okay. So I got this from the EU website. This is the current account balance between EU and China. So CA's current account, EU. So this is in terms of euros with respect to China. It's negative. Makes sense, right? They buy a lot of stuff from China, and so the net trade, the net current account between these two countries, negative, right? It's negative basically for the last 10 years. Okay. This is the GDP. The reason I have this number is because I want to make this variable stationary. It's important when you run time series analysis, there are no trend lines, because if you have trend lines, you have a problem. You have a bias in your estimation of your coefficients. So I'm going to scale the current account by GDP to make sure that's stationary, but you don't have to do that. I'm just doing it so that the coefficients are not super big. Okay, so I'm going to scale the current account by GDP. This is the exchange rate between euro and Chinese yuan. Again, this is the price of euros in terms of Chinese yuan. But since I'm analyzing from the perspective of the EU, I'm going to take the inverse, right? The inverse is therefore the exchange rate of the price of Chinese yuan in terms of euros. And lastly, these are CPI levels. This is the EU CPI level indexed at 2015. And this is the Chinese CPI level indexed at 2015. Okay. Why do I have these three columns? Because these are my inputs for Q, right? Q equals EP star. That's here, okay? And you can see it, right? I take the inverse of the exchange rate, I multiply by foreign prices, which is Chinese CPI, divided by European CPI. That's Q. And it looks pretty stable, right? It looks pretty stable. So that's good. Remember, stationarity is good, okay? QL1 is a lag. So this value is the previous value. There was another row, but I deleted it. So there was a 2014 January, but there's missing values, so I dropped it, but still I can get a lag value, so I kept that. So this number, you can see these numbers are the same, right? So it's just a lag, right? These numbers are also the same. This number, I'll just do this one, see? These are the same. So it's just the previous value. Why am I doing this? Well, I need a feedback effect so that I can generate a response, okay? I have to shock some variables, and that variable may have a delay, and those delays are captured by these flags, okay? And then finally, I created this variable. This is the, this variable. This is the current account scaled by GDP. So the current account deficit with China is around 2% of GDP for the EU, which is I think it's quite large, right? And this is the lag, right? So the model I'm trying to estimate is the following. I want to analyze the current account scaled by GDP, okay? As a function, in the linear model. So there's a constant term plus beta, let's call it beta naught, beta 0, multiplied by Q, right? That's the most important variable, plus beta 1, the lag of Q, if there's a delay effect, right? plus the lag of CA. So beta 2 CA L1, and then plus epsilon. I hope you've seen something like this in your other classes, right? This is just econometrics, right? Just running a regression, time series regression, right? One country, time series regression, and I'm trying to estimate the coefficients first so that I can simulate a shock, right? I know I know the response over time, right? See how long this response can go on CA. Okay. Make sense? Okay, I hope the data is explained well enough. Okay, so I will just estimate the regression right now. So let me open up a new sheet. This is the same data, okay? This is okay, so to make things, all right, I think here is, the yellow is highlighted, that's the dependent variable. That's the Y on the regression. And these are the independent variables on the orange, okay? I'm going to estimate a regression. That's very easy. Go to data analysis, go to regression, right? And then let's highlight this column for the dependent variable. The independent variables are these columns. Let's add labels to them. Let's output to here. Doesn't matter. And let's estimate it. Okay, there we go. Now I'm going to take these parameters, right, and put it back into here. So the parameters I've estimated is the constant, the beta naught, the beta 1, the beta 2, right? Those are the parameters I estimated. And I'm going to generate an impulse response. So let me show you what I mean. So it's the same regression, right? The same coefficients. So I put these coefficients up here just for easy access. This is the constant term, beta naught, beta 1, beta 2. Okay. Q, the lag, and then the lag of the dependent variable. So at time before time 0 of the shock. So again, the idea here is that I'm simulating a shock to one of the variables, a unit shock. So that's the unit shock of Q. But I am assuming that the current account level between Europe and China is equal to 0, meaning there's a trade balance. So assume that we have balanced current account between China and Europe. So at -1, we have a current account balance of 0. At time 1, there's a shock. Okay. The current account, therefore, is equal to the constant term plus beta 1 times Q, right? Beta 2 times 0, because Q hasn't, at time -1, nothing has happened, right? So it's 0. And the current account in the previous time is 0, right? So this is the pure shock event after one iteration, right? At time 1, there's no more shock to Q anymore, right? So it's 0. The lag of Q is 1, right? Because that's what's the shock at time 0. And then the previous current account level is here, right? So these numbers are always the same. The next period's current account level is just, again, inputting these parameters, this one, multiplying by the coefficients, right? The estimated coefficients. That should be equal to the next period's current account, right? That's all we're doing. We're just moving forward over time. So I do that, and I'm just going to plot this column. I'll plot this column against this column. So let me highlight this just to, oops, I thought I did blue. Okay, good. So this column and this column is right here. This is it. Okay. So you can see that if I were to shock Q, increase it by 1 unit, the current account actually drops, right? by, in this case, 10%. 10% is a lot, but just remember that Q is a 1, right? Q equaling to 1 is a big number, okay? So anyways, drops by 10%, but then over the period of 6 quarters, do we get the Marshall-Lerner condition holding? Okay, so you can do this on your own. So if you can manage to find current account levels between countries, US versus Canada, US versus Mexico, blah, blah, blah. You can look it up for, I'm sure the central bank has websites that has these kind of current account breakdowns at a quarterly level. You can do this type of exercise yourself. You have the exchange rates, price level are easy to get because they're just CPI, right? And you can estimate this time series regression yourself and then simulate the shock. And you'll see this pattern yourself. Okay. So despite all the theory emphasis in this class, right? I just shown you that you can do this, all this stuff is empirically verified. I just didn't show it to you because it's a little bit tedious. All right. Questions. So this, right? This is verified, right? Verified empirically, can be tested using time series regression. All right, so before we take a break, let me talk about this minor thing here that we already talked a little bit about before, sterilization. So this is important because um, it's for some countries, uh, in which there is a difference in risk profile of their debt versus some other countries, it's possible to manipulate exchange rates without changing money supply. So as long as you have differences, like differences between riskiness of the debt that's being issued by certain countries and therefore big deposit rates, then one way to get an effect on exchange rates is just to do what's called sterilization. So keeping money supply different, you're just swapping, changing the composition of your portfolio or your asset balance sheet such that your asset or your trading partner's asset becomes more risky. I'm talking about bonds here, okay? So yeah, that's the idea. But let me talk about sterilization, how it's done first, okay? So sterilized intervention are open market operations, but all you're doing is changing the composition of your balance sheet, but keeping money supply constant. Okay, so this only really makes sense if there is a fundamental difference between foreign assets and domestic assets, and therefore changing the overall privately held supply of these bonds may change the riskiness of these assets. Uh, Otherwise, doing this doesn't make any sense, right? If these assets are comparable, meaning that they're substitutable, perfect substitutions, then it doesn't matter how you intervene in the markets, okay? But anyways, that's the next step we'll talk about after the break. So sterilized intervention, but start out with a balance sheet. As usual, let's just focus on a simplified version. So we have two types of assets, foreign assets, domestic assets, and we have money supply. Right, so this is what we're working with. When we conduct a open market purchase of foreign assets while keeping money supply constant, what we will do is try to decrease this first and expand the holdings of foreign assets, right? So step one, we sell some domestic assets. So let's move it up. We are like this, right? So we go into the open market and we sell domestic bonds. When we sell domestic bonds, we take back some of the money in the system. And so overall monetary base decreases. Make sense? So that's step one. Sell domestic assets, buy foreign assets or currency. Okay. Maybe it's more clear if just buy foreign currency. Sorry. Not yet, not yet. Sorry. Sell domestic assets. Sell domestic assets, withdraw currency from economy. All right, step two, we're going to expand. So this line will now be expanded. So step two, print money to buy foreign assets or currency. Doesn't matter. I'll just say foreign currency. It's fine. So this moved here and then back, right? So nothing has happened. So no change. Here now, right? Bigger. A larger piece of the pie than before. Bigger. And this is smaller. So no inflation is created. All you are doing is swapping assets, right? On your balance sheet. So why would you do this? You are doing this because changing private holdings of this may impact the likelihood of your country's credit worthiness. So the intuition here is, so why would you do this? Perhaps changing private holdings of BECB changes riskiness of uh, interest rate returns on deposits. Bankruptcy, default, etc. All right, so the next thing is to augment the UIP curve to capture this additional risk premia term. Okay, this risk premia is supposed to represent imperfect asset substitutability between sovereign debt of different countries. If there is different riskiness, then you must demand an additional return on top of the bank deposit return, right? That's the idea. And it's going to be a function of how much sovereign debt, domestic sovereign debt, is circulated publicly or privately. All right, let's take a 10-minute break and then we will talk about augmentation of UIP curve. And then we will talk about how to use fixed exchange rates to your benefit, okay, if you decide to adopt that regime. Okay. Let me pass around the attendance sheets and please sign in when you have a chance. Not there?
About the last picture, you said you can ask us a fair question in the very exam. I didn't quite get what was the question and what's the answer.
Suppose you start out like this,
Yeah.
and the question says, country decides to decrease its current account target.
Okay.
Show me what it looks like on a graph,
Just lower the yeah.
okay? What sorts of policies can you implement? Okay, second question. Uh, is the current target below or above the current equilibrium?
Yeah.
Yeah, something like that.
Oh.
Can I ask you something like that? So, well, according to this graph, equilibrium can either be here or here compared to here, so it's gonna be lower,
Yeah.
right? Second question,
Which
third
one?
third question, how can you achieve an equilibrium and hit the target? Find equilibrium that hits this new target.
Oh.
So first question, how do I change x curve? Second question is what the potential equilibriums is it above or below the current one?
Okay.
Third question, what sorts of policies you can implement to achieve a stable equilibrium, which is here or here? Here you can shift DD, here you
Oh.
can shift AA, right? This is just,
Okay.
right?
Oh, okay.
Makes sense?
Makes sense. Yeah.
Okay. Oh, yeah, simple, right?
Yeah.
Okay.
But in terms of the left point or the right point is the decision of central bank to change DD or AA, right?
Well, this is negative output. If you want to sacrifice output, then
Oh.
this is okay. If you don't want to sacrifice output, this is better.
Okay, so actually in reality,
It depends.
central bank
It
will-
depends on what I tell you. Like, suppose you don't want to sacrifice output. There's only one
Okay, okay.
option, right?
But is this side any disadvantage since we have better outcome?
The disadvantage here, this side. The disadvantage only arises if you can't move the DD schedule,
Oh,
right? If
yeah,
this
so-
side means you need to change DD somehow, but if you
Yeah.
can't, but you still want to hit the target, then pause from just the policymaker's perspective.
Oh,
Okay, fine,
okay.
I need to be here, but fine, I'll take a hit, but that's
Okay.
my target.
Okay.
Again, the whole point of doing this is, I don't know, you think the current account is too high. I don't know, something,
Oh, okay.
I don't, for whatever reason, maybe this is, I don't know if it's a good reason or not.
Okay, okay.
Yeah. But usually you want something on, to the right.
Yeah.
Right? And you think about how to achieve that on the right, because again, the whole purpose of today is just that, right? How
Okay.
do you cause this to lead to that?
Okay.
Right.
Understand.
Yeah.
Thank you.
All right. Let's finish up. So two more things I need to talk about. Two big things I need to talk about, right? But let me now give you a more generalized equation for UIP. So uncovered interest rate parity presumes that assets, sovereign debt around everywhere, doesn't matter which country you're thinking about, it has comparable risk profile, meaning that the likelihood of default of you not receiving your interest payments is basically zero or the same everywhere. And so when comparing interest rates, the only thing you have to worry about is the expected depreciation of the home currency, right? That's the only thing you have to worry about. That's one thing. The other thing is that we've assumed that investors are risk neutral, right? So meaning that there's not only is there any additional risk factor coming from differential and riskiness of the assets, but there's also the fact that we're assuming that some investors don't have, may be risk averse, right? We're assuming that it's possible. And so one way to capture that is just to add a catch-all term, right? This catch-all term is rho. Okay, this rho represents something called imperfect asset substitutability, as I mentioned earlier, because some assets are risky and people are risk averse, and therefore you demand additional return on top of the expected depreciation to offset, that extra risk, right? So that's one reason, risk aversion, but there's also, as I mentioned, differences and because you're comparing two different type of assets with different risk profiles. In that sense, then you need to adjust, right? You need to adjust the UIP to offset the extra risk. And so this rho is supposed to be a catch-all term. But for this class, we're gonna be explicit that it's just a function of the amount of sovereign debt that's being held by private institutions. So the idea here is that if you have more creditors, right, you have more people holding onto your debt, there's more debt you need to service, and therefore that increases the likelihood of default, right? Your country going bankrupt. And so increasing the holdings, private holdings of debt increases rho because domestic returns are not high enough. Domestic bank deposits are not high enough to offset that risk. So you need this additional risk factor to increase it. So assuming rho is positive, right? Rho being positive means that domestic debt is riskier than foreign debt. Make sense? Okay. So I wrote it here just to emphasize, right? Positive rho means that domestic assets are relatively more risky or riskier because you demand more positive returns on top of the bank deposit R to offset the extra risk, which could be coming from your own risk aversion, or just coming from the extra risk that it's no longer risk free, right? The extra risk from your debt. A negative rho means that domestic debt is relatively less risky. So meaning that it means that foreign bank deposit returns require additional premium, right? In order to hold on to foreign debt or deposit your money in a foreign bank account. Okay, make sense? So rho, just like E, is taking from the perspective of the domestic country. So rho is on the right-hand side, means that you need to offset the risk to compensate for the extra risk holding onto domestic debt. Okay. All right, so let's formalize rho as a function of B-priv. B-priv stands for domestic bonds that's privately held. This can be decomposed into two parts. Total bond issued, right? This is the total, TOT stands for total bonds issued for a country, minus the bonds that's being held by the central bank, right? Bonds being held by the central bank is as if the country is holding on to their own debt, is like quasi-retired. So not so many creditors, less likely to default. So if I replace B-priv with B total minus BCB, then changing the holdings of domestic bonds held by the central bank can change the private holdings of the bond everywhere else, right? And so if I were to increase central bank holdings, this becomes more negative. More negative. And so total private holdings therefore declines, in which case rho declines, right? So more bonds that's being held by the central bank, either through open market purchases, decreases private holdings, decreases rho, which makes bank deposit returns safer in your home country, relatively speaking. All right, so based on this equation now, you can see that in my lecture notes that I will sometimes be explicit that rather than conduct open market operations with domestic bonds, I will change foreign assets instead. Because again, changing BCB can change the holdings of domestic bonds privately, which could distort UIP in the direction that I don't want it to be, right? But if I conduct my open market operations with foreign assets, then I don't have to worry about, the directional changes of rho, right? Because BCB is untouched. Make sense? Okay. So what does a sterilization look like? Right. So what does a sterilized intervention in favor of foreign currency look like in the short-term model? And how does that change exchange rate without changing money supply, right? That's kind of what I want to show you. So this will look like the following. So suppose we do not change money supply, but we have imperfect asset substitutability. What that means is that the UIP curve needs to be augmented with rho. So UIP now is R equals to R star plus E hat E over E minus 1 plus rho, which is a function of B TOT minus B CB. C lowercase. So suppose I am going to purchase foreign assets under imperfect substitutability. So this means that there's a rho, okay? If I'm buying foreign assets, that means I am keeping money supply constant. Sorry, if I'm buying foreign assets and keeping money supply constant, I have to finance this purchase with a sale of domestic bonds. So let me write that down. The purchase of foreign assets is financed by the sale of domestic bonds in order to keep money supply constant, i.e. sterilization. If I sterilize the purchase of my foreign assets, that means that I will sell this. So less bonds being held by central banks makes this number smaller. A number minus a smaller number means that this entire expression increases, which means rho increases, right? Because it's more private holdings, right? Of BCB, B of B. Which means that the inequality will distort this way, right? In order to restore parity, E needs to move in a direction that lowers the entire right-hand side, so E must increase. So any choice of R, so suppose R is here, the entire UIP curve has to shift up. So without changing money supply, which could have subsequent price effects, I can simply change the composition of my balance sheet in terms of foreign and domestic assets, and I can achieve a depreciated current domestic currency, which is great, right? You can use this effect now to boost the current account, right? And to boost output. So simply by swapping assets in your balance sheet with imperfect asset substitutability, you can get an output effect, right? Pretty cool. So you can take advantage of this if you believe this is true. This, right? There's a rho term. All right, so going forward, I'm not going to make any assumptions of whether or not assets are perfect. I'm just going to assume that there could be. And if I were to conduct open market operations, I would probably do it with foreign assets because it doesn't distort BCB in the other direction, right? So when I conduct monetary policy, if I conduct monetary policy, right, and I buy domestic assets, I would be increasing this. right? If I decide to shift this down, BCB will increase, which will make rho go down, which is bad, right? It moves E in the wrong direction. So I don't want to touch this. What I want to touch is something other than B, right? Some foreign asset. Okay, foreign currency, doesn't matter. As long as I inject liquidity into the system and I don't touch the private holdings of government bonds, then I won't distort UIP and I achieve what I want to achieve, which is a devalued currency, right? Okay. Now let's talk about the virtues of fixed exchange rates. So this is a big picture summary of the cost and the benefits of fixed exchange rates. The first thing you should note is that if I decide to adopt a fixed exchange rate regime, it requires me to dedicate my entire monetary policy toolkit to maintain it. So every time there's a deviation away from the peg, I have to change money supply so that the price doesn't is restored back to its original level, because that's what a pegged exchange rate regime means. It means I have to maintain it no matter what. What you will find, here's the cost. Okay, so minus sign here, so it's a bad thing. Okay, I have to give up something to get something in return. So what do I get in return? I get the benefit of very effective fiscal policy, as I will show you. Okay, so fiscal policy expense. So the nut shift. What's this? How do you visualize this? So recall from last week, when you have fiscal expansion, that's going to appreciate your currency. That's a big no-no under pegged exchange rates. So in response to a appreciation of the domestic currency, you need to depreciate it. So fiscal policy has to be used in conjunction with monetary policy to keep the exchange rate fixed. But in doing so, you get the full potential of the pegged exchange rate. I mean, the fiscal policy, one for one, right? $1 spent in government spending or tax cuts, you get $1 output, right? So that's a pro. All right. I don't know if this is a pro, but this is conditional that other countries and your trading partners still thinks your currency is credible. So even if your exchange rate is fixed, you can still choose to devalue or revalue it, but you just can't do it that frequently. So if you're in trouble, let's say your economy is contracting, or you're stuck somewhere, as I'll explain, like in the case of Japan, you can devalue your currency at a new level, a new peg, and still get an output effect. The cost of doing that, however, is if you do this too frequently, nobody will trust your currency anymore because it's unstable, right? You just devalue your currency at will, and nobody will trust the value of your money anymore. So this can't be used infinitely. It has to be infrequent, maybe every 10 to 20 years, right? All right, so this is a plus minus, okay? It depends. All right, so that's the big picture benefits of fixed exchange rate. So you have to give up monetary policy. Fixed benefits is fiscal expansion is super effective. You get the full potential. You can still use monetary policy through devaluation to get out an output effect, but if you do this too frequently, nobody will trust the value of your currency anymore. So there's a pros and cons. So that's the idea of that's the virtue and the cost of pegged exchange rates. So I'm just going to spend some time explaining you to the scenarios in which having a pegged exchange rate may appear beneficial, okay, as opposed to a floating exchange rate. All right, so let me show you. Okay. So implications first, right? The implications first is under a credible pegged exchange rate, the expectation of your future spot rate is a constant, right? Assuming there's near zero probability of devaluation, revaluation in the future, then my expectation must be equal to some value that's equal to the peg. Okay, if that's true, based on UIP, then interest rates have to move together between the country that I'm pegging it to. Then the central bank therefore must stand by to immediately adjust the money to supply to maintain this equilibrium. Make sense? So whenever, if you've been reading the news, every time every time the Fed announces an interest rate change, HKMA will do the same, right? You probably noticed in the past 5 years. Okay. So let's analyze a scenario what must occur under a fixed exchange rate, but now we have an output shock, okay, in this short-term model we had before the midterm. So let me show you what this looks like, or what has to happen under a fixed exchange rate regime. So we have a starting point as usual. We have L, have R, and we have E naught. So pegged exchange rate, this is must be preserved. Okay, so this must be true. We announced to the world that this is, believe me, believe my central bank, we will commit our currency to this value. So please come and bring your business here. We will preserve the value of the money that you use for your businesses in our country. Okay, that's this value here. If there is a positive output shock, the L curve will shift away from the origin, right? Because L is a function of R and Y. And when Y is positive, demand for money increases. So the entire curve shifts away from the origin. But this makes interest rates want to increase, right? So how do you restore? I'll put a question mark here, right? This is where interest rates want to go. Okay. That's a no-no because this point here, we are at this point here, but we want this point here, right? So how do we hit back the curve again? Well, we have to use monetary policy, right? We want this point here. This is the only feasible point, and we have to find somewhere to hit the L curve down here. And we can do that by shifting money supply down. So MS prime under sticky prices, right? So therefore, the short run is here. Short run is here. And remember, under this situation, right, R equals R star, and E hat E equals E bar, right? It's a constant. So no matter what, we must have interest rates stay the same, R equals R star. And so if there's an output shock, central bank has to come in to devalue its currency so that we maintain this pegged exchange rate. All right, so that is not interesting, right? Short run analysis, everything has to stay the same, and you just have to move lines here so that interest rates stay the same. Now, if any of this stuff is forever, even though this must be true, right? This must be true forever. If you implement something like if this output shock somehow is permanent, it doesn't matter. You don't have to do any intervention because this output shock will push E downward, right? But the monetary policy must be in place forever too, which pushes E upward. So nothing happens, right? It doesn't matter. So if everything is undone, then if everything's temporary, then we're back to square one. But if things are permanent, then we're still we're still in the same place, okay? Then we'll still be here. So the price effect in response to monetary policy and so two things, right? Also price wants to go down in response to prices want to go up. Prices want to go up in response to, let's see. So prices want to go up because of the monetary expansion, right? But prices want to go down because of the output. Output is deflation would have occurred after that dimension. Yes, deflation. So that's from output, right? This is this, right? And this is this. So they cancel each other out. That's what I'm saying. So it doesn't matter. Okay, so after the intervention, prices do not adjust over time. Deflation that would have occurred in the absence of intervention is fully offset by the inflation of the monetary intervention, right? So all this doesn't matter. If prices are fully flexible, a positive output shock will result in immediate offsetting deflation. So no monetary intervention needed. So nothing needs to be done to maintain the peg in the long run. So there's no further action necessary. So I think this is just to show you that whatever happens to R, whatever happens to E, if there's forces pushing E in any other direction other than staying still, you have to use policy actions to restore it back to normal, right? But just note in this scenario, in which the output effect requires you to change money supply, in the long run, when prices catches up to these effects, they cancel each other out. So it doesn't matter. All right, so that's a demonstration of what the central bank needs to do in response to an output shock. All right, so what happens if you do a monetary shock? Okay, suppose there's a sudden increase in money supply. So I think you already know the answer, what's going to happen. If there is a monetary expansion, the central bank needs to find some way to undo the expansion because the peg otherwise would not be maintained. So consider this following graph. A, a reason to increase money supply. You're gonna get a shifting up, but you realize that, wait a second, I've committed to an exchange rate peg. And if this deviation is not permissible, right? I cannot have this point here. So I must find a way to shrink myself back, right? So if this occurred, I have to find some way to sterilize it. So I'm back here again. So any attempt, anything that happens, to money supply that's beyond the central bank, maybe there's a destruction of money. I don't know. Maybe some country decides to destroy your money supply. You need to find some way to replenish it, restore it. Okay. So monetary policy is fully useless here, right? Because you just need to find some way to maintain that peg. All right, fiscal expansion. So you've already seen this before, right? The only thing that's different now is fiscal expansion must be used in conjunction with monetary policy in order to maintain a peg. sorry. Okay, good. This is E equals E bar. This is AA. This is DD. Fiscal expansion means DD curve shifts to the right. Right, such as this is DD prime. This entire gap is either plus delta G or plus C delta T, right? That's the full 1-to-1 effect on output. If I did not intervene with monetary policy, I am forced to accept an output level of Y2 here because of the crowding out effect coming from exchange rate appreciation, right? That crowds out my full potential. So it's less than 1-for-1 per spending, government spending, or tax cut. Oh, sorry, this is a minus sign. It should be a minus tax cut. But because I am committed to the pegged exchange rate, the AA schedule must shift so that I'm back here, right? So that's this line here. So I have to find some way to increase AA, and that can be done through expansionary monetary policy, buying foreign currency, injecting liquidity to the system, and that will devalue my currency back to this point here. Make sense? So obviously, right, yeah. So again, not interesting because this is your short and long run effect. In the short run, if it's temporary, you're just back here again. If it's permanent, you just have to maintain this expansion forever too, right? And so you still get Y1, right? So nothing interesting, just like the previous example. All right, so far so good, right? It's just showing you firstly, if there's any change or deviation from the peg, central bank has to use its monetary policy to restore the peg. That's number one. So I gave you an output shock. Number two, monetary policy is pointless because if you decide to have a monetary shock, or if there is one, that's random, you have to use monetary policy to revert it back onto the peg, right? The exchange rate has to be restored back. Third, we find that our fiscal expansion is permanent, is effective, fully realized, because fiscal expansion must be used in conjunction with monetary expansion in order to maintain the peg. All right. And now, this is assuming you don't change the peg, right? But that's not true. People devalue their currency all the time if they're on a peg. So now I'm here to show you that devaluation can get an effect that's almost identical to permanent monetary expansion, which we saw last week. All right, so I'm just gonna do it because the mechanism is all the same. All right, but I'm just gonna explain to you the subtle differences in a revaluation case versus just a permanent monetary expansion. So just like permanent monetary expansion, devaluation is changing the peg and just telling the universe, telling the world that it's going to be maintained at this new level indefinitely, so forever. So here's the AA schedule, here's the DD schedule. This is the old peg. This is the old peg, so I'm going to call this peg bar 1, okay? And if you choose to devalue your currency, that's going to change your expectations for sure. So it's as if it's a permanent monetary expansion, right? Then the A schedule will shift all the way up here to achieve this new higher E and also higher output. So very effective, which is not surprising, right? Because we saw from last week under flexible exchange rates. So this is Y naught, this is Y1. And so this is your short run equilibrium for the same reasons as explained last week, right? You jump from this point to this point, output as long as the E here is higher than this E here for a given Y, output wants to move this way, right? Or E wants to move down, but output wants to move this way until we achieve this equilibrium. Okay. In the short run, in the long run, prices will respond. And of course, the A schedule must move enough to only reflect EHA-E, but no change in MS, because prices have caught up to the change in MS, just like as before. But it has to intersect at a point on the new pegged line, right? And so the final long run equilibrium has to be something like this if you want to make output 0 or impose PPP. So this is your long run equilibrium. And you can see they are on this new exchange rate line. And the same logic as before, this point drops to this point, it moves along this line. And then DD curve shifts to the left because price levels respond and output will stop decreasing or changing once delta Q over Q is 0. And this is precisely here, right? And we are on the new peg as a result. All right, so to summarize, under sticky prices, expectations change because just like a devaluation, the expectation is now increased to a new level because you announce to the world that you're going to move the exchange rate to some other higher value of E indefinitely. So EHA-E will change just like in a permanent monetary expansion. And so AA schedule will have a very strong shift upwards. In the long run, the logic is the same as before. You have increasing prices, which makes the A schedule drop a little bit. And so it's still, drop a lot, but still elevated because the change in MS over P is now, the change in P has made the ratio a constant now. And so it's only reflecting the change in expectations. All right, so everything else, all the mechanism is just the same as before, as last week. And so here we can also impose PPP, right? PPP is imposable. So under imperfect substitutable assets, a revaluation is most successful if central bank has sufficient reserves. So remember, when we do OMO now, we're thinking about imperfect asset substitution, and we should be buying and selling foreign assets. So in a revaluation in which E is going down, E bar is going down, then you need sufficient reserves to sell, right? Instead of buying. If you run out of these reserves, then you have problems, right? Foreign reserves, yeah, foreign assets. So this is just a caveat, a side note, essentially. Permanent exchange rate devaluation, so this is very similar to permanent monetary expansion under flexible. I want to talk about and the wrapping our discussion on exchange rate determination is how to use currency devaluation to get out of a type of recession in which you can no longer leverage monetary policy to affect interest rates. Okay, so there's a long history about this scenario in which we are stuck at what's called a zero lower bound. So why is this a big issue? Well, uh, when you were growing up, you may have noticed that Japan experienced a recession and they cut interest rates all the way to 0%. And despite cutting interest rates all the way to 0%, people didn't want to spend money. And in fact, what the joke was that the only thing people were buying were safes to put their money in. That's the only thing that people were buying. So they had deflation, they had no room to cut interest rates to spend money. And this was a problem because if you cut interest rates to negative, you would just take your money out, right? Out of the bank. Because negative interest rates means you're paying the bank for depositing your money. Okay? Uh, in response to that problem, several economists suggested that rather than do nothing, you can try devaluating your currencies in order to restore your ability to conduct monetary policy. Okay, so let me show you visually what that means. I forgot one more thing I didn't talk about, but let me tell you that first. All right, so when you have this situation in which you're stuck at the zero lower bound, you have interest rates set to zero, right? Because we're stuck. This is what the zero lower bound means. But if you still want to combat a recession, you need to do something. All right, so what are the implications of having interest rate equal to zero? Well, that means that the exchange rate is equal to this. E equals to expectations of the future spot rate divided by 1 minus the foreign interest rate. You can derive this from UIP, right? Because you just set the left-hand side equal to zero and then solve for E. So it's just some number, right? So if we were to plot this, this is what it would look like. It looks like the way it is. Okay. This is MS over P equals to L, R equals 0, Y. So what this means that I can't change R anymore. And if I were to change money supply in any way, the only other free parameter I have at my disposal is Y. So I have to increase Y to increase L. Do you see? E can no longer be held constant anymore, right? I mean, changed anymore. And so Y is the only other free parameter. And so if I decide to increase my supply, I'm basically just shifting the A schedule this way, right? I'm stuck, right? No more room to increase A upward. I can only move rightward, right? It's like I'm just moving to left and right. This flat line is equal to E hat E divided by 1 minus R star, right? Just as before. we're stuck. Cannot use monetary policy anymore. What you can do to get out of this liquidity trap is called liquidity trap because no matter how much liquidity you provide, it changes nothing in output. So what you can do instead is you announce to the world that you're going to devalue your currency. So if you devalue your currency, you're going to change expectations to a higher level, and therefore E will shift upward. And hopefully you shift somewhere high enough that allows you to restore this healthy relationship between E and Y according to the AA schedule. So why is it downward sloping here? Well, this is assuming that if I increase income large enough, right, then there's now room to change interest rates in which people want to save, right? So that's why I'm assuming that further along the y-axis, there is some point in time, some point in the y-axis in which there is a trade-off between E and Y, right? So maybe you're allowed to devalue your currency enough such that that trade-off is available to you again, right? In which case you can expand monetary policy in such a way in which you can shift the AA schedule upward, right? Here, right? So maybe this is AA double prime, AA triple prime, but you get the idea, right? So this new peg is E hat E prime over 1 minus R star. On this scenario. So this has occurred in the 90s for Japan. Nobody really paid attention in the US because we never reached that level before until 2007, 2008. In 2000, 2008, we hit that bound. And it wasn't clear whether or not what the US could do to kind of restore the monetary policy toolkit back. But luckily we didn't do this. Some countries did resort to negative interest rates. If you recall, Switzerland made interest rates negative, and apparently it worked. Or it didn't work as intended. People still parked their money, but people didn't take their money out either, right? So maybe there was a diversification effect, requirement that forces people to hold negative interest-bearing assets. Okay. But in any case, it was an interesting period to study bonds during 2007, 2008. Okay. But anyways, to recap, if you are stuck in this liquidity trap in which you cannot cut interest rates anymore, this is zero lower bound, yet you still want to recover your monetary policy ability to affect interest rates and therefore output, you should consider devaluating your currency and fixing a peg. So if Japan did this in the 90s, they may have gotten out their recession earlier and restored their ability to cut interest rates again to move the AA schedule up, right? All right, so it's of course, it's important. This is important, right? The central bank needs to have credibility in order for it to achieve this outcome. If beliefs don't move, then you're in trouble. So you can't do this all the time, right? All right, one last thing I want to talk about that I skipped over is the announcement effect of a currency devaluation. So the reason I'm mentioning this is because I don't actually have to do it. I don't actually have to conduct monetary policy in order to see a change in exchange rate. A simple announcement can change my expectations, right? And that's enough to get things going. So just a pure announcement effect will move the UIP curve upward, right? Because R equals R star plus E hat E over E minus 1. If this term is just increasing and nothing else, right? Then E has to move to wipe out that increase. So the UIP is moving upward. So suppose this is the old peg, the new peg would just be up here. And I didn't change money supply yet, right? I didn't change money supply yet. And yet I still get this new level, right? The new peg level, regardless, right? And it's all because of expectations, right? That's it with pegged exchange rates. So to summarize, pegged exchange rates, there are trade-offs. You give up monetary policy autonomy, but that doesn't mean it's useless. You just have to use monetary policy to support the maintenance of the peg. So if there's a recession, you have to do something to maintain the peg. If there's a output increase, you have to do something to maintain the peg. It doesn't necessarily mean that monetary expansion is not part of your toolkit. It can be, but you have to have the credibility to devalue your currency. And everyone has to believe that you can do it or maintain it. Then the effect on output is the same, just as you did in the previous weeks, right? With a permanent monetary expansion. Everything else is almost the same. You just don't get this overshooting because overshooting is a no-no, right? Can't overshoot in this scenario. Okay. The announcement effect is already very powerful in itself under a pegged exchange rate because again, if you have the credibility, you can already move the exchange rate instantly. And also with that credibility, it's another tool at your disposal to get yourself out of a liquidity trap. So this is a unique thing that it's a solution. It's a unique solution for this scenario, which we have encountered in the past. So it's possible this becomes another possible tool to get yourself out of a jam in the future if we ever reach the zero lower bound again. All right, so the reasons for fixed exchange rates, it's particularly useful for central banks of emerging economies with currencies that are not very actively traded or a reserve currency. And so having a fixed exchange rate disciplines the central bank, preventing them from printing money arbitrarily, for example, to pay off their debt. So pro for a fixed exchange rate of emerging economies. With that stability, it promotes trade and investments. Again, because you are a developing country, you're developing your credit, so pegging your currency builds up that reputation and credit worthiness. So pro. All right. It eliminates monetary fragility because any sort of shock to monetary, because the exchange rate is pegged and fixed, then we know that all your monetary action is just to maintaining that peg. So it doesn't matter, right? Fiscal policy is more effective, right? Because you get the full potential of the fiscal expansion because because in actuality it's fiscal expansion in conjunction with monetary expansion in order to maintain the peg, right? That's why it's more effective. And lastly, some may argue that having pegged exchange rates across different countries facilitates economic policy coordination, but I think you can say the same thing about flexible exchange rates, right? If I cut interest rates, you cut interest rates, when we do it together, we're making things easier for everyone, right? So I don't see this argument particularly compelling. All right, the case for floating exchange rates, because we're just relying on market forces, there's an automatic stabilization mechanism in place. So that means that if there's a mispricing, it's self-correcting, right? That's the main feature of having markets in the first place, as opposed to micromanaging everything. There's no such thing as currency shock. So imagine a scenario in which the US decides to increase interest rates rapidly. When they do this, Hong Kong dollar will become weaker and the exchange rate will hit a bound. So the HKMA needs to find some way to strengthen the Hong Kong dollar in order to maintain its peg. But in order to strengthen the currency, it needs to flood the market with US dollars. It needs to sell US dollars, right, and buy Hong Kong dollars to make it stronger. But if you run out of things to sell, right, if you run out of US dollars, you will encounter an attack, right? Then you are forced to depeg, right? Causes instability because everybody's expectation was that you maintain the peg, but if you're going to depeg because you run out of stuff to sell, then you're going to have chaos, right? So you have to have a large reserve of foreign currencies if you're going to manage your exchange rate. But if you adopt a floating exchange rate regime, then it doesn't matter. You don't need the reserves. There won't be a tax because everybody's allowed to speculate anyways. Okay. And it's sustainable in the long run, and for the same reason why there's automatic stabilization. So ideally there's no bubbles. If there's bubbles, then it'll be resolved or corrected quite quickly. Okay. You get monetary policy autonomy. You can cut interest rates at will, so it doesn't matter how it affects exchange rates because you're allowed it to float. And as I mentioned earlier, you get economic coordination as well, just like pegged exchange rates. You just have to coordinate your interest rate cuts together or lend to each other in a certain way that it's possible, right? You don't need a peg to have coordination. And lastly, I think it's fair. I think you can make the argument that if you have floating exchange rates, it's fair. You don't have people hoarding other currencies, intentionally devaluing other currencies, right? To boost your output, etc. The game is symmetrically fair. And it's really just the creditworthiness of your currency, right? Or your country, which determines the strength of your currency, as opposed to just artificial removal or injection of supply of someone else's currency into the system. Okay. So based on that description, you can already see the trade-offs, right? The question you'd be asking yourself is it possible to get all the benefits of fixed exchange rates and all the benefits of floating exchange rates and none of the cons? And the answer, of course, is no, right? Based on this slide. It's impossible to get all three features of these two types of regimes. So capital mobility just means that you have a stabilization effect, right? You're allowing speculators to come in, UIP to hold, etc. So no bubbles. Exchange rate stability just means that, fixed exchange rates, no uncertainty, no risk, right? So you get this with pegged exchange rates, you don't get this with flexible exchange rates. And monetary policy autonomy. So you get to change interest rates to maintain or to facilitate your own internal governance of your country, right? To fight recession, etc. So can you have all three? And the answer, of course, is no, right? And let me go through 3 examples to explain. So suppose you adopt a fixed exchange rate, which gives you exchange rate stability, and you also accept capital mobility, so you have a stabilization effect. If you do these two, we understand from our analysis of pegged exchange rates that I have to give up monetary policy to maintain exchange rate stability. So the choice of 1 and 2 forces me to give up 3. Right? One demonstration of this policy trilemma or impossible trinity. Okay. Example 2. Suppose I adopt capital mobility, so the stabilization effect. I also allow myself to freely conduct monetary policy, but that means that I automatically give up price stability. So I have 1 and a 3, I have to give up 2. And lastly, if I adopt fixed exchange rate, I have price stability, but I also want to conduct monetary policy. Well, guess what? You have to give up this stabilization effect coming from capital mobility. Right? Basically, this is saying I may find some way to stop UIP from holding. Right? That's what I'm saying. Can I stop UIP from restoring to its parity? If I can, then yes, you can have fixed exchange rates and freely conducted monetary policy. So you can kind of already can guess which three countries I'm talking about here. The first one we have is Hong Kong, right? Fixed exchange rate, capital ability, stabilization effect as long and also price stability. Example two, we give up the price stability. This is USA. And lastly, this is China, right? They have very, very tight controls of capital moving in and out of the country. And they do this for a reason, right? Because they want to have some control over the path of the exchange rate as well as an ability to expand and contract money supply to fight recessions. In a lot of textbooks, they usually draw a triangle to demonstrate it's a trinity, meaning that you have to choose one. You can only choose one edge to get the benefits of to get the features of the three features I talked about. So the three features are exchange rate stability, monetary policy, autonomy, and lastly, capital mobility. All right, so if I choose this side, stability, this is China, right? I have everything, but I have to give up this. So that's China. If I have this and I have this is Hong Kong. And if I have this, this is everyone else in the developed world. So here you have to have capital controls, right? This side you have a currency board, right? No monetary policy. And lastly, here you have to have floating exchange rate, FX rate. Okay, so in the course of history, of course, in the course of history, we haven't always been here, right? We've been shifting between here for quite a while. So just because it happened in the last, I don't know, 50 years, it doesn't mean that the past 100 years we were the same. All right. So if we look at across history, under the international gold standard, we had 1 and 2, right? 1 and 2 is capital ability and fixed exchange rate, but no monetary policy, right? We know that now. Afterwards, we have something that looked like today. So during this period, this interwar period, we had capital ability and all relatively autonomous monetary policy. In the early Bretton Woods system, we had no capital mobility, but fixed exchange rates and monetary policy autonomy because of interventions by the IMF. Okay. After the dollarization policy, we went back to 1 and 2. So we had capital mobility and then dollar peg, right, to everything. Every currency is pegged to the dollar. And now today we have 1 and 3 again. Right. So just because we are here doesn't mean we'll be here forever. Who knows what's going to happen in the future? Okay. All right. So that's the end of our discussion on exchange rate determination. So if you have questions about this week's lecture, I'm happy to answer them now. Starting next week, I will shift gears. So no more economics, I promise. So I think people are kind of sick of the abstractness of this FX stuff. So next week I will do risk management. So some of you are in accounting and may not be super fresh or familiar with derivatives. So I will spend some time describing derivatives again, just to give you, just to make sure we're on the same page so that nobody has any sort of advantage or disadvantage because they haven't seen it before. Okay, so you'll see it again. It'll just be review if you're a finance guy, but for those accounting people, I want to catch you up to speed. And then we'll talk about hedging primarily, using against foreign currency risk, right? That's the whole point. the last third of this class. All right, if you haven't signed in the attendance sheet, please sign it in now. If you haven't picked up your midterm, you can pick it up front. Otherwise, I'll see you guys next week.